Free and clear of the chatter from Wall Street, you're listening to Talking Stocks Over Beer, hosted by hedge fund veteran and newsletter writer Mike Alkin, who helps ordinary investors level the playing field against the pros by bringing you market insights and interviews with corporate executives and institutional investors. Mike sifts through all the noise of mainstream financial media and Wall Street to help you focus on what really matters in the markets. And now, here is your host, Mike Alkin.
Welcome to the podcast. It is Tuesday, July 24th, 2018, right here in the dog days of summer. It used to matter when I was a Mets fan. I still am, but I think if you were listening to the podcast, you heard me talk about early in the season, they were 11-0, and God, I was on cloud nine. But I think I put a caveat in there that I said, it's still the Mets. Here we sit on the 24th of July, and the Mets are the worst team in baseball. It's just, right? So when you're a baseball fan, you look forward to those dog days of summers. They're grinding it out. If you're in a pennant race, it's fantastic. But when your team's the worst team in baseball, the dog days of summer take on an entirely different meaning. So now I'm watching Yankee games. When you grow up in New York, you're a Met or a Yankee fan. You're not both. But here I am watching them because they have one of the most exciting lineups in baseball. And season's halfway over, and baseball for me, as I know it, is over. So now I'll just enjoy watching the Yankees and Red Sox battle it out. Anyway, hope you had a good weekend. Friday night, we were at a neighbor's house. They were having a birthday party, a bunch of friends over. Always nice to get together with people and see them. And a handful of Wall Street guys were there, and some non-Wall Street guys, which I really like, right? Get a bunch of Wall Street guys sitting around talking. I mean, after a while, right, it just kind of gets old. You talk about the same thing over and over. So I was talking to a few people there that have their own businesses, and we were talking, and somebody was asking me some questions about stocks, and just started talking. And it's not like everyone wants to know, what about this company or that company? I don't know, right? I know what I know. But I talked about that. I said, well, look, here's kind of a framework in how you think about it. So, it got me thinking, right? I lay out a framework in how I think about investing, and that framework and that playbook has been developed over 20 plus years. And when I think about it, I was thinking about it. That was Friday night, was the party, and I was thinking about it yesterday. I was thinking about, wow, that, you think about investing, and when I first started, I really had no clue, and I was just grinding it out and working hard. I'm very numerate, so I've got that going for me. I have an accounting degree, but in terms of just the art of investing, I really had no idea. And over time, as it works out, you think about all the mistakes that I was thinking, all the mistakes I've made in investing, and I still make mistakes, but how after each mistake, I was taught very early on, a long time ago when I worked for Joe DiMenna, to do a postmortem. You're going to make mistakes, but do a postmortem on the mistake, and hopefully you build on it. And I think about that throughout the years, and all of the mistakes that I've made in investing, and the learnings from them. And you keep building upon those learnings, and hopefully you don't make the same mistakes twice. Sometimes you do. But as years go on, you tend to, at least for me, I reduce the same mistakes, right? But you still make them sometimes, right? And sometimes you really have to keep your emotions in check, right? It's easy to say, just step back and take your emotions out of the investment process. And I think over the years, I've done a very good job at that. But the market is amorphous. It's moving, it's breathing. There's huge volatility. And while it gives you great comfort to know that you're steeped, the work you've done, at least the work I've done, is steeped in valuation analysis, primary research, field work, this big laundry list, checklist that I have. But still, when those things are moving, you're still a human, right? So you have to try and step back from it, and you do. And I'm way more often than not able to. But you still swing around a little bit. But I was thinking about the conversations we had, and how over the years, my process has gotten more fine-tuned and fine-tuned, and my investment philosophy has been fine-tuned and fine-tuned, and to where now, after 20-something years, I'm very comfortable with where I am as an investor. So it's funny though, because as I was thinking about this yesterday, I had time to think about it, because I'll tell you in a minute what I was doing. Because of all of the lessons I've learned from as a professional investor and have built upon those to become a better investor, I don't carry those sometimes into different aspects of my personal life. And if you're new to the podcast, this will be the first time you're hearing it. If you listened before and you've heard me say this, I apologize. But I come from a very humble background. I come from a blue collar, working class, lower middle income background. My grandparents raised me. He was a longshoreman and a mechanic on the waterfront in Brooklyn. And my grandmother was a seamstress, and they worked 12, 14, 15, 16-hour days, and a very, very hard working. So, I didn't have to be taught about hard work, right? It was part of the fabric, part of what I saw every day growing up. You keep your mouth shut, you put your head down, and you grind, and you don't complain. You just do it. And that served me well over my career. It served me well in life, especially, in the investment world, where you could work sometimes, at some of the bigger hedge funds, right? I was working, you're working 15-hour days, sometimes 18-hour days. So it's a grind. And my grandfather, he could fix anything. He would look at something and he could fix it immediately. It didn't matter, right? Anything broke, a neighbor would come over, something happened, he'd go there, he'd look at it, and I was witness to this. He'd look at it, he'd step back, he'd think for a second, he'd say, okay, here's what we need to do. And my God, did we have the tools to do it. And, they say sometimes just by osmosis, you pick things up. That didn't work for me. So when you fast forward all these years now to my life with my family, right? I have that blue collar mentality. I'm a grinder. Nobody shovels my snow. Something needs to be taken down, I take it down. It's just kind of the way it is. I enjoy it. I can have someone come in and do my snow. I can have someone come in and take something down. But I enjoy doing that, and it kind of makes me, feel like I'm in the grind, and that's fun for me. Taking stuff down, grinding out, doing things, demolition, I'm your guy. Fixing something or putting something together, I am an absolute deer in the headlights. I learned nothing in the 20-something years I grew up in my grandparents' home. Literally nothing. There was no osmosis. There was nothing that transferred over. I think back when my daughter she's a teenager now, but we were living in New York City, and it was the summer, and we got her first tricycle. And so my wife got this big box delivered to the apartment, and I sat there, and we were going out to my in-laws, and I put the bike together. Well, the instructions, it shouldn't take long, whatever it said, it should take an hour or whatever. I'm going on 10, 12 hours. It's a weekend, and I'm sitting there, and my wife is out on the terrace, and she'd come in. She'd say, everything okay? I'd say, yeah, I got it. And then she went out shopping, took our daughter, came back. Doesn't look like you made much progress. I got it. This went on and on. So it went from the morning to lunch through late afternoon. I finally think I have the bike put together. It is put together. The next morning, we go downstairs. We get our car out of the parking garage. I put the bike in the back. We get out to my in-laws. Now, my father-in-law, blue collar guy, really good guy, very handy, can do anything. And we're excited. We're out at their house on Long Island, and we're going to put our daughter on on her first tricycle, and everyone's outside with the camera is going to take pictures. We put her on it. She pedals. The entire thing falls apart. The handlebars come flying. The wheels go everywhere. It was a disaster. My daughter was fine. When I tell you we were crying, we were laughing so hard. And it's funny though how sometimes, as with investing, luck is a great thing. I mean, I've had some winners where my thesis was kind of right, but luck was by far the reason why something worked out. Well, luck was on my side this day because my father-in-law looked at me. Now, I've known him for a very long time. And he looked at me and he said, "You are never putting together anything for my granddaughter again." And subsequent to that, now he has a grandson. And he said, I will put everything together. Now, we're probably talking 12 years now. I don't think I've put together a Christmas present for my kids in 12 years. He happily comes into our home, drives in to come see us in a different part of Long Island. At Christmas time, puts them all together. So I had some luck on my side. Now, I also had some luck on my side where not too long ago, I was trying to put together a garbage pail, a simple garbage pail for our outdoor patio. And I took it out of the box and I looked at it. Now, it's got 4 walls and a top. I was going on it about 2 hours. And my wife I could see her peering out the kitchen window. She finally came outside. She said, "Are you struggling with that?" I said, "No, I got it." So again, I have the deer in the headlights. I put it on. Whatever I did, it was wrong. It didn't work. But thankfully, we have a neighbor, Kathy, who can put anything together. And her husband told me a long time ago, "I don't do anything. Kathy does it all. She'll be happy to do it." So now I've learned anytime we need something put together, all it is a bottle of wine. Kathy comes down, hangs out with my wife, and puts it together. So I've had some luck on my side and stuff like that. So there are things where life imitates art, and luck is a part of investing, and luck can also be part of your regular life. For me, it's a blessing. So that was my weekend. But really, the reason I had time to think about it yesterday was getting back to doing things on your own. My wife and daughter decided they're going to redecorate her room. I could tell when there's movement around the house, and there's people in my house that I'm not really sure who they are. I've seen over the years with my wife, whether it's she's having something done in the house, and she tends to know that if I'm focused on work, I might sometimes just not pay attention. And turns out somebody came in to help my wife and daughter figure out what they wanted to do with the room, and part of it's when we built the house years ago, handful of years ago, we had the wood floors done in the kids' rooms, but the person helping my wife figure out what to do with the rooms decided they were going to carpet the room until a later date, and they didn't, and now we were pulling the carpet up. And I was in yesterday, and I said, "You know what?" I said, "You don't need to bring in floor guys. I'll do it." She said, "What are you talking about? You don't have time to do it." I said, "No, it'll be cathartic for me. It's good." I said, "I'll pull up the carpet and I will." She said, "Yeah, but then they've got all those things on the side with the tacks and stuff. How are you going to get those up? You're going to wind up doing something." I said, "No, I'm totally fine. I got it." So there I go. All the stuff comes out of the room. I tear up all the carpet. I tear up all the felt underneath the carpet. The wood floors look in great shape. But those things that sit along the edge of the entire wall where they tack the carpet down to? What a disaster. When I tell you, my hands I could barely touch the keyboard. I was dropping the F-bomb probably every 15 minutes. It was absolutely crazy as I was trying to get those things up and cutting my hands. I've got Band-Aids all over me. And I was thinking, don't you ever learn? Sometimes you got to let go. But that gave me the time to think a lot about what I'm going to talk about in today's podcast. So anyway, that was my weekend. It was relatively watched some British Open golf, enjoyed that. Always love watching the British Open. As times moved on in life, I don't play a lot of golf anymore. I used to play a ton when I was younger, and then in my 20s I played a lot. I was never a great golfer because when I say a ton, I would play once a week. And I might be able to shoot at that time, maybe in the mid 80s. Now, if I get out once or twice a year, since I've had kids, I just decided that I'd rather spend the weekend with them, and during the week I just don't have time. And I don't want to spend 4, 5, 6 hours at the golf club on the weekend. When we moved out from the island, from New York City to Long Island, I don't know, 9 years ago, I forget what it was. We did join a golf club, and I thought, you know what, I'll pick it up again. And even though, I'll play it at late afternoon, early evening, maybe. And the kids were much younger at the time. And I won't get into what it costs to join a golf club and what they charge you annually. And I wound up playing once a year, maybe twice a year. So figure that out per round, and it was ridiculous. So, but I love watching it. I love the history of golf. I love the gentleman nature of it, the sportsmanship. And so yesterday was great watching the British Open. So, we talked a lot about over the number of podcasts. I think you've heard me say I like deeply cyclical industries. I like the natural resource complex. You could catch things at inflection points. And one of the things we've seen over last forming is from a valuation standpoint, the commodity complex has been really, really beaten up. And when you compare it to equity valuations, like you look back on a chart and they're really, really cheap. And it started to have a surge, but that surge has been really upended here in the last short while. So I thought it would be good to get a guest I had on the podcast before to come back and talk about it. So we're going to bring on Peter Sainsbury, and who focuses on the commodity complex. And we're going to spend some time talking to Peter about his views. So Peter Sainsbury, welcome to the podcast.
Hi, Mike. Yeah, good. Thanks for getting me on the show.
Yeah, my pleasure. You and I met through Twitter, and you are one of the guys on Twitter at Peter Sainsbury #7 that I read every day.
Glad to hear it.
Your focus is on the commodity complex, on the commodity markets, and I always learn what's going on. I mean, I pay attention to the commodities, but I think you have a really interesting take on things. And I think the last time you were on the podcast, we were talking, and I mean, the commodity prices have been down for quite a while, and we have right, and the valuations in many of the commodities and the commodity index really, really cheap. And we started to see a rally in them, over the May, June time period. You saw copper really take off.
Yeah.
And but just recently, over the last short period of time, you've seen almost like a commodity contagion taking place, where you're seeing some of these prices start to really back off. And you've seen there's emerging market currencies that are really hitting these producer nations. And while some people might be lulled by the calm financial markets, I'm trying to wonder, like the inputs in the global supply chain are kind of flashing something's going on. So now the commodities kind of approaching this correction type territory, and they're under pressure again. The dollar has been on fire. Global trade tensions out there. How are you thinking about the commodity complex right now?
Yeah, I think it's a great question. I think I'd like to kind of sort of take a step back and kind of consider it in the context of both sort of business and commodity cycles. So both kind of short term and long term view of things. And I think you mentioned trade wars, and clearly that's something that's getting the market's attention recently. But I think in the context of the business cycle, I think the signs have been there for a while that the global economy and in certainly particular countries have been showing signs of slowing down for a while. So you've got in China the decline in the credit impulse. So that's a kind of a measure of new credit within the economy has been slowing down. The fall in Chinese equities, things like South Korean industrial production, which tends to be quite a good leading indicator of sort of global trade and activity. So all these things have been kind of flashing red for a little while, even before the current kind of drop in metal prices and some of the concerns over trade wars. Mm-hmm. So you could argue that perhaps the business cycle has topped out earlier this year. We experienced the kind of sort of the Goldilocks scenario. Everyone was it wasn't too hot, not too cold, and it seemed like a good times were ahead. But things sometimes are always the rosiest when you're at the peak. And I don't think this is perhaps any different. And I think in a kind of longer term context, I think yourself, commodity markets move in long term cycles, and we had that big run up in prices from the late the early 2000s up until sort of 2008 and then to 2011, and then we've had a in general a kind of a run down from prices then, but with periods where prices have surged. So I think maybe we were perhaps hoping for more in terms of upside potential than perhaps we. I think the market perhaps got a bit ahead of itself. If you think about the run up in metal prices.
Yeah.
Sure there was a strong demand, but there was also the cuts to capacity in China as well on environmental concerns.
Mm-hmm.
So I think that both you seem to see both of those both long term and short term business cycles and commodity cycles as being kind of behind where we are at the moment.
Peter, that's it. You brought up metal prices, and it's timely because they're very correlated with world economic activity, and over the years I come to see that they could predict short-term movements in GDP, right? Because consumption moves closely with it. As if we had a blank canvas right now for listeners, and they're trying to balance out the cheapness of the global commodity complex versus what to be looking for to understand if the valuation is going to increase. I mean, how do you think about it? What do you look at? Is it metal prices, or what with a blank canvas, what are you focused on when you're forming your viewpoint?
Yeah, I think metal prices, particularly copper. Its nickname is Dr. Copper. And I think it's partly for a reason that it tends to give a good signal of future economic activity. You've got to think about the supply side as well, but certainly it does give an indicator of where demand is heading. At the moment it's not looking too promising. Mm-hmm. But I think in taking a kind of a wider context, I think it's looking at for markets that are overly pessimistic. Number of companies has declined. Investors are leaving the sector. There's just no appetite there for investment. And then I think it's kind of looking for those opportunities where there's big potential for growth in the future. If you think about economies tend to grow through like an S curve, so they start off slowly and then have a big surge in demand and then kind of tail off. And I think it's kind of part of what I look for is looking for where those countries which are kind of at that sort of bottom part of that S curve. Mm-hmm. One of the ones I'm sort of looking at the moment is India in particular, especially around its oil demand. Mm-hmm. At the moment it's when you compare India with someone like say China, the level of urbanization is very low. It's kind of back to where China was in 2003, roughly. So there's a big potential for growth and big potential for demand to grow in terms of oil consumption, but also the infrastructure that economies need to develop as well. I think it's taking, it's looking at all those different factors, both sentiment, positioning, and the kind of broader fundamental factors as well.
Mm-hmm. And when you're thinking about it, do you weigh them as you're looking at as a portfolio of commodity investments? What's your view in terms of, do they all move in the same direction, or are when you're thinking about weighting a portfolio of commodity investments, how do you what's your thought process there?
Yeah, that's a really interesting question. It's very very difficult. I think it's about clearly at different stages. The signs, they're not all flashing green. Some of them are flashing red.
Mm-hmm.
You need to weigh up those signals through time as to whether they signaling hold to your current level or increase your exposure. But I think in general, I think it's about taking a position and gradually expanding it once those certain sort of milestones you go past. So if you're looking for signs of supply discipline within a commodity market, and and that there's evidence of that happening, then that's a sign that the market's moving through that cycle. And then depending on what your risk appetite is, it might be a sign to increase your exposure in a particular market. So I think it's kind of taking all those things into account. But I think what's really important is to kind of really sort of document your decision process, so you've always got something to go back to 6 months ago, or longer, and say, there was this and this piece of evidence, and that's what resulted in me making that decision. So I think it's easy to become emotional about an investment, in hindsight. But if you've documented it, analytically ahead of time, that can be a real help.
Yeah, very much so. Yeah, I find writing things out, it helps my thought process quite a bit. Mm-hmm. I mean, I was looking through the Bloomberg Commodity Index, and I think 22 of the raw materials in there have fallen since May, and live cattle, cotton, and orange juice futures were the only ones bucking that trend. Right. And copper was down almost 20%, I think, since then. And you see the same with the emerging market currencies, where I think of the 24 tracked by Bloomberg, something like 20 or 21 of them have been down, and you've seen the big losers such as South Africa, which produces a lot of base and precious metals and coal, and Brazil exports iron ore and agricultural and petroleum, and then Chile's a major copper producer, and it's Russia too with its natural gas and metals, and so you've got this looming trade war, you've got all this uncertainty about Chinese demand weighing on the prices. I mean, how do you think about this? What does it portend for just developing nations in general? How do you view what you're seeing with this kind of pain that's taking on? Is there a contagion that can occur from this, or how do you view that?
Yeah, I mean, if you go back to like the late 90s, especially the Asian financial crisis, there was certainly an element of contagion, because there was a high amount of borrowing in dollars. I don't think the situation is as extreme as it was back then. I think the banks and the governments have, I believe, typically kind of learned from that episode. So I don't think they're necessarily as exposed as they were before. But that, I think there is an element of contagion from an economic point of view, in that we've had the decline in the renminbi, and that's partly caused the decline in some of the other emerging markets as well. So I think as China, it becomes a more challenging market to import some of those materials that it needs, some of those commodities. That will put pressure on some of those emerging markets that are very heavily heavily involved in commodity exports.
Right. Yeah, one of the things that I'm wrestling with right now is as I think about the commodity prices, right, the pass through of them isn't always so straightforward because while on one hand it indicates a level of demand, but if your commodity prices are not increasing so much, right, that dampens inflation. And if you think about monetary policy to some degree, they're focused on keeping inflation in check and not letting growth get to run away, and which could ultimately keep rates down, right? And the market for a long time has been thinking they got to go up. So you think about what role that plays. But on the other hand, right? So I mean, how do you think about that?
Yeah, I'm kind of thinking of it from the point of view of what happens when the next crisis hits. Whether that's what we talked about, an emerging market crisis that envelops the rest of the world in some way, or who knows where it's necessarily going to come from. But the question is, what will central banks do in that scenario? And you've got to think that they're running out of ammunition. Certainly of the conventional kind. So that kind of points towards something quite extreme, I think, that potentially could happen in terms of ammunition, quantitative easing, to infinity, whatever that could mean. And that potentially in the short to medium term could be really quite a strong wind behind metal prices and precious metal prices in particular.
Mm-hmm. I really like as a natural resources and commodities. Sometimes you can catch industries that are out of favor and sometimes might be able to buck the trend a little bit. I mean, I mentioned 3 earlier. I don't know anything about orange futures or cattle or cotton, but not unless I need to, and I haven't paid much attention to it. But you're always on the lookout for commodity markets that have fallen out of favor that people hate, right? So you get a sense for fair value down there, and I know like me, you're always looking for asymmetric returns where the downside is limited, right? And the upside potential is high. One of the markets that's been drawing your attention lately has been the potash market, and potash along with phosphorus, nitrogen, it's one of the nutrients that go into making fertilizers. So why don't you talk about, if you can, the backstory on potash and what attracted your attention to it?
Yeah, I think it kind of goes back to some of the sort of things we've been talking about in terms of markets that are really out of favor. But there's a story, both a short and a kind of long-term story about the potential growth of the market. So as you say, fertilizers are used for potash is used as a component of the fertilizer complex. So it's used for helping in the agricultural sector, and it's, I think, where it's going to be particularly valuable is the growth of as societies get richer, they tend to consume more sort of protein-rich food, particularly meats and dairy products, and the commodity that's most sort of entwined with that is the soybean market, and so what we're seeing within other parts of Southeast Asia is that really strong growth in growth of soybean demand, and the end consumer market for protein-rich foods. Mm-hmm. So there's a short-term potential for growth there, and I think there's still many countries which are kind of behind the curve in that growth story as well. I think the other factor that's kind of key to this is who actually buys fertilizer. It's the farmer that sees it as a real valuable input to his crop. But if agricultural prices keep on falling, farmers tend to try and cut their costs, and one of their costs that they can cut is the amount of fertilizer that they put on their crop. But what we're kind of seeing is that really sort of agricultural commodity prices are they're kind of at their peak pessimism. We've had a big growth in global stocks of crops over the last 4 or 5 years. We have had really good weather in all the growing regions, particularly the US and Russia. But that is highly unusual. There's a chance, and I think it's probably undervalued by the market, of some kind of disruption in terms of weather or geopolitical related. And then I think the third factor is things like supply discipline. So we mentioned it previously as one of the factors I kind of look out for as a sign that the market is bottoming out. And we're starting to see that in the potash market as well, particularly around Canadian producers. And taking all those factors into account, and a higher production cost as well, with the rise in energy prices, and then you can kind of see that there's a potential for kind of a real sort of supply shortfall coming up over the next few years. And what we've seen in terms of potash prices is they've tended to sort of bottom out at around about the sort of $220 to $240 a ton mark. That was about in early 2017, and they've ticked up to around, say, $270, $280 dollars a ton. And gone up about $10-20 a ton in the last month or so. So I think the signs that the market's kind of responding to those fundamental factors.
Well, it's interesting. It's almost like a textbook cycle, right? You go back to, I think it was in the earlier part of 2007, where prices bottomed out at about 170 per ton, and within a course of a year, prices were nearly $900 per ton. And you've mentioned it was the perfect storm, right? You had this really tight supply, you had really growing demand, which was biofuels in the U.S. and Brazil, and then you had higher livestock production that created more demand, and right. So then you have all the grain reserves, they come historically low, and prices go up. And what does that bring on, right? So then all of a sudden you've got these high prices result in demand destruction. But those high prices attracted all of these big mining companies coming into the space, putting in these new projects, unearthing all these new supplies, and then prices go right back to where they were. So I mean, it's so typical of what you see in the commodity markets at peaks and troughs. And now you mentioned supply discipline coming into the space. I mean, when you're what do you find more interesting, a demand-driven market or a supply short market, when you're thinking about cycles at the bottoms, when you're looking at the commodity space?
I think potentially supply shortages are potentially more interesting just from a purely a timescale perspective. When markets are short of material, the reaction in terms of higher prices tends to be that much quicker, which can be a benefit to an investor if they can recognize those signs in advance. Whereas a kind of a evolving demand picture but it does vary. Tends to be a much more longer term story from an investment point of view.
Yeah, for sure.
Yeah.
So now during this downturn in the commodity cycles, like how are you spending your time focusing? What are the things that investors who are listening should be taking their cues from? What is the top things that have your attention right now?
Yeah, I think perhaps going back to what we talked about right at the beginning of the conversation was about some of the factors that are weighing on commodity prices at the moment. I think there's more perhaps kind of downside to commodity prices. Speaking generally about commodity prices, in the short term. But I think it's kind of looking out for those factors where that the situation could change quite quickly. So we've got a real sort of narrative at the moment about trade wars, which I think is certainly a factor. But I think the impact of it and the narrative, the effect on prices has probably been overplayed. So I think maybe it's to kind of look for that period of peak pessimism, when it really does look like the trade wars really starting to build up as a time for when perhaps investors should start to kind of think about putting their toe in the water again. Because I don't think it is probably in famous last words, of course, but it's going to be as bad as the current narrative is making out.
What tell listeners about materials risk? What and your project there?
Yeah, no, it's my website materials-risk.com. It's a website blog I started up quite a few years ago now, but it's something where I kind of use to sort of share my thoughts on different commodity markets. I kind of use those to help me develop my own thinking on particular markets, but also to kind of sort of share insights to people that read my blog as well. Kind of a form of education as well, both for me and for wider investors as well. So it's kind of been really useful, and it's kind of led to me writing 2 books about commodity markets as well.
You and I have a similar view, and we talk so much about it's all about incentives, right? And, why don't you share your view on that? For me, it's so many of these things when you're investing is you have to understand what motivates people and what incentivizes them. So I share your view on that if you would, because I know you've devoted quite a bit of time and research to it. So why don't you share your view?
Yeah, well, I mean, we've touched on the incentives that both the sort of demand and supply side of the fundamental factors. But there's also kind of a broader context of that investors need to be aware of, that people that are in the industry, whether it's investment banks publishing forecasts on commodity prices, or people producing newsletters kind of touting sort of junior mining stocks. Some of the research can be great. I think it needs to be thought about as a kind of for entertainment purposes only, and perhaps just to kind of spark your own interest in doing your own research on a particular market. But I think you always need to consider the incentives of why people are publishing this apparent research, which could say so and so's stock is going to do go up tenfold. This commodity price is seriously undervalued, because it's the incentive is to market their service, their newsletter, their investment banking services. The incentive isn't to help you as an investor to make a better return. So I think it's all about I think the lesson behind all of this is really to kind of do your own research. I think it's great that there's so many podcasts like yourselves and others that really kind of helping investors delve into how different markets work, what factors to look out for. But at the end of the day, it's kind of you as an investor need to understand your own incentives behind whatever position you decide to take, and it should never be based on a forecast or what a newsletter says you should put your money in.
Yep. So before I let you go, I mean, we talked potash, but are there any other commodity markets that you are excited about, and any that you are concerned about right now on the edges?
Yeah, I think I'm starting to kind of look a bit more into the precious metals sector, particularly gold, but also platinum is looking quite interesting as well. Just purely from a kind of a peak pessimism point of view, there are sort of indications that perhaps investors again have become too pessimistic on there, and building up too many short positions in the futures market. So I think other than that, I'm kind of taking a watching brief over the summer, and then kind of coming back to it in a bit more with a bit more research in later on in the year.
Anything in the commodity complex really have you worried?
Well, I think something that's looking quite interesting is the sugar market, in that it's come down quite a lot, and it's still sort of struggling around the 11 mark, having been over 20 just over a year or so ago. And I kind of thought that perhaps all the bad news was in the market, but I think there's signs perhaps that the supply is perhaps even larger than the market had initially believed, and that's there's probably sort of a good argument that prices perhaps going to stay around that level, or even perhaps going down towards 10, later in the year.
It's a good point. You seeing markets that are down 50, 60, 70, 80%, whatever they may be from their highs, that's really just a starting point. You can't buy things just because they're down, right? So they could stay, one of the lessons I've learned, they could stay lower for a lot longer than you think they can.
Exactly.
Right. So yeah. Exactly. Well, listen, Peter, thank you for taking your time and giving our listeners an update. I promised them when you were first on that I would have you back a few times throughout the year. So this is the second time that we've had you on, and I like your view on taking a tour of the commodity complex and what's going on right there. So I appreciate you taking the time.
Yeah, thanks for having me on.
Talk soon. Thanks.
Bye-bye.
Well, I hope you enjoyed listening to Peter Sainsbury. I always follow him on Twitter. I think he has some interesting insights. So he's one of the go-to guys that I look to for commodity insights. Find his work to be quite interesting. And I tried to keep the interview a little bit shorter this time. I know it's the summer. It's the middle of summer, and last thing you need to be doing want to be doing is listening to me babble on for an hour and a half or hour and 45 or whatever it may be. So I'm endeavoring during the summer months to shorten it, but there's a lot going on in the commodity space. It had a big move up earlier in the year, and now it's come down quite a bit. So I just wanted to get his take on it and share that with you. And over the next, and we're going to be bringing a few people on over the next couple of weeks. I have a distressed investor coming on to share his insights with you, and of course, we'll also be keeping the regular commentary going on uranium. So we've got a bunch of stuff in store for you. So. Anyway, I hope you enjoy. If you're on vacation, I hope you're enjoying it. If not, I hope you go on vacation soon. We'll be back next week. Have a great week. Thanks.
The information presented on Talking Stocks Over a Beer is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility.